Question 1. Topic: Reinsurance accounting and financial reporting. Which of the following accurately reflects the primary purpose of statutory accounting principles (SAP) in the reinsurance industry? A. To maximize profits for reinsurers by focusing on forward-looking financial estimates. B. To ensure the solvency and financial health of reinsurers for the protection of policyholders. C. To provide detailed guidance on international reinsurance taxation policies. D. To encourage speculative investments by reinsurers to increase returns. Answer: B. To ensure the solvency and financial health of reinsurers for the protection of policyholders. Explanation: Statutory accounting principles (SAP) prioritize the financial stability of insurers and reinsurers to protect policyholders, ensuring that they have sufficient reserves to cover liabilities. Unlike generally accepted accounting principles (GAAP), which focus on profitability and comparability for stakeholders, SAP is more conservative and emphasizes solvency. Options A, C, and D are incorrect because they misstate SAP's core purpose, which is ensuring the company's ability to meet obligations under regulatory oversight as stipulated by the NAICS accounting standards. Question 2. Topic: Underwriting and risk assessment. An insurer decides to use catastrophe modeling to determine the appropriate premium for reinsurance coverage. Which of the following factors should be primarily considered during the modeling process? A. The historical loss data of similar insurers in the region. B. The insurer's underwriting portfolio, including geographic exposure and policy limits. C. The reinsurer's administrative expenses and profit margin. D. The number of intermediaries involved in the reinsurance transaction. Answer: B. The insurer's underwriting portfolio, including geographic exposure and policy limits. Explanation: Catastrophe modeling involves assessing the insurer's exposure to natural disasters or other catastrophic risks by analyzing their underwriting portfolio. Geographic exposure, policy limits, and potential aggregation of risks are key components. While historical loss data may provide context, it is not the primary focus. Catastrophe modeling. Options C and D are unrelated to the core objective of catastrophe modeling, which is to predict potential losses and determine adequate reinsurance coverage. Tennessee regulations often require insurers to integrate such models for accurate pricing and risk management. Question 3 scenario. Topic: Claims and settlements. MS Turner, a claims manager at an insurance company, has submitted a reinsurance claim to their reinsurer following a severe storm in Tennessee. However, the reinsurer disputes the claim, arguing that the primary insurer's underwriting practices were overly lenient and contributed to excessive claims. What principle should guide the resolution of this dispute? A. The principle of utmost good faith, requiring both parties to disclose all material information. B. The indemnity principle, which ensures that only the insured's actual loss is compensated. C. The follow the fortunes doctrine, obligating the reinsurer to honor settlements made in good faith. D. The principle of insurable interest, mandating proof of financial stake in the insured risk. Answer: C. The follow the fortunes doctrine, obligating the reinsurer to honor settlements made in good faith. Explanation: The follow the fortunes doctrine requires the reinsurer to accept and honor settlements made by the cedent primary insurer in good faith and in accordance with the reinsurance agreement. This principle limits the reinsurer's ability to second-guess the cedent's underwriting or claims handling decisions. Option pertains to disclosure during contract formation, while B is about compensation principles in insurance contracts. Option D relates to the insured proving financial stake, which is irrelevant in this dispute. Tennessee-specific reinsurance protocols often uphold the follow the fortunes doctrine to ensure claim settlements are smooth and predictable. Question 4. Topic: Reinsurance contracts. Which of the following best describes the characteristic difference between facultative and treaty reinsurance agreements? A. Facultative reinsurance is mandatory for the cedent to purchase, while treaty reinsurance is optional. B. Facultative reinsurance covers individual risks or policies, while treaty reinsurance covers an entire portfolio of risks. C. Facultative reinsurance is more commonly used for catastrophic risks, while treaty reinsurance is used for daily operational risks. D. Facultative reinsurance involves automatic coverage, while treaty reinsurance requires negotiation for each risk. Answer: B. Facultative reinsurance covers individual risks or policies, while treaty reinsurance covers an entire portfolio of risks. Explanation: Facultative reinsurance is negotiated for specific individual risks or policies, while treaty reinsurance automatically covers a portfolio of risks without individual negotiations for each policy. This allows insurers to manage large portfolios of risks more efficiently. Treaty reinsurance, while facultative reinsurance is often used for high-risk or unusual individual policies. Options A, C, and D misstate the fundamental differences between these two types of agreements. Question 5. Topic: Legal and regulatory framework under Tennessee law. Which of the following is a primary requirement for reinsurers to receive credit for reinsurance? A. Reinsurers must have at least 50% of their business originating from foreign markets. B. The reinsurance must be with a licensed, admitted, or authorized reinsurer. C. Credit for reinsurance is granted only if the reinsurer offers excessive loss coverage. D. The reinsurance agreement must contain a clause specifying a minimum payout schedule. Answer: B. The reinsurance must be with a licensed, admitted, or authorized reinsurer. Explanation: under Tennessee law, a primary insurer may only receive credit for reinsurance if the reinsurer is properly licensed, admitted, or authorized to conduct business in the state. This requirement ensures that reinsurers are subject to the same regulatory scrutiny as insurers, providing a safeguard for policyholders. Option A is incorrect because there is no specific requirement for a reinsurer to have foreign market exposure. Option C is not correct as excessive loss is a type of reinsurance, not a requirement for credit. Option D is irrelevant as there is no standard minimum payout schedule requirement under Tennessee law for credit purposes. Question 6. Topic: Reinsurance market practices. Which of the following factors most likely influences the current trends in the Tennessee reinsurance market? A. Changes in international solvency regulations and their impact on global reinsurers. B. Fluctuations in the U.S. Federal Reserve's interest rates and its effect on investment returns for reinsurers. C. The development of new catastrophe modeling software reducing the need for manual loss estimation. D. Increasing reliance on reinsurance intermediaries due to the complexity of regulatory compliance. Answer: B. Fluctuations in the U.S. Federal Reserve's interest rates and its effect on investment returns for reinsurers. Explanation: the Tennessee reinsurance market is influenced by macroeconomic factors such as interest rates set by the Federal Reserve. Reinsurers' investment portfolios are sensitive to interest rate changes, as lower rates may reduce investment returns, affecting their overall financial health and pricing strategies. Option is incorrect because while international solvency regulations may have an indirect effect, interest rates are a more direct factor. Option C is partially true but does not have a significant impact on market trends compared to interest rates. Option D is also true but less impactful compared to the broader macroeconomic trends. Question 7. Topic: Catastrophic risk management. Which of the following is the most important factor to consider when modeling catastrophe risk for a reinsurance portfolio in Tennessee? A. The historical frequency of claims for specific types of claims such as slip and fall incidents. B. The geographical distribution of insured properties and their exposure to natural disasters. C. The total number of reinsurance treaties in force within the portfolio. D. The total value of premiums written across all policies without considering geographic distribution. Answer: B. The geographical distribution of insured properties and their exposure to natural disasters. Explanation: catastrophe risk modeling primarily focuses on the geographical exposure of insured properties, particularly in areas prone to natural disasters such as tornadoes, floods, or earthquakes. The geographical concentration of risks helps to predict potential losses in case of a catastrophic event. Option A is incorrect because slip and fall claims do not impact catastrophe risk modeling. Options C and D are irrelevant to the core objective of modeling catastrophic events, which requires understanding geographic risk distribution rather than the number of treaties or total premium amounts. Question 8. Topic: Critical thinking and problem solving in reinsurance. If a reinsurer determines that the original insurer has failed to adequately assess a specific risk in a treaty agreement, what action should the reinsurer take in light of the follow the fortunes doctrine? A. The reinsurer must deny the claim regardless of the primary insurer's mistake. B. The reinsurer should accept the claim if the primary insurer acted in good faith despite the error. C. The reinsurer is entitled to reduce the liability based on the primary insurer's underwriting mistake. D. The reinsurer may choose to renegotiate the treaty terms retroactively to adjust for the mistake. Answer: B. The reinsurer should accept the claim if the primary insurer acted in good faith despite the error. Explanation: under the follow the fortunes doctrine, the reinsurer is typically bound to honor the decisions made by the original insurer if those decisions were made in good faith, even if mistakes were made in underwriting. This doctrine fosters stability in the reinsurance process, ensuring that the reinsurer cannot second-guess the primary judgments. Option is incorrect as the reinsurer cannot deny claims solely based on mistakes unless fraud or bad faith is involved. Option C is not accurate as the reinsurer cannot reduce liability unless specific contractual provisions allow it. Option D is not correct because reinsurance terms cannot be renegotiated retroactively without mutual consent. Question 9. Topic: Reinsurance contracts when drafting. A reinsurance contract, which of the following is typically not a standard inclusion in a treaty agreement? A. The reinsurance premium rates and payment schedule. B. A clause specifying the reinsurer's right to modify the treaty terms at their discretion. C. The types of risks covered under the treaty, including exclusions. D. The procedure for submitting and handling claims between the cedent and reinsurer. Answer: B. A clause specifying the reinsurer's right to modify the treaty terms at their discretion. Explanation: reinsurance treaties generally specify clear terms regarding premiums, coverage, claims procedures, and exclusions, but they do not typically grant the reinsurer unilateral discretion to modify the treaty terms. Treaty agreements are negotiated and mutually agreed upon by both parties, and any modifications would consent from both the cedent and the reinsurer. Options A, C, and D are all standard inclusions in treaty agreements, ensuring clarity in coverage, financial obligations, and claims handling. Question 10. Topic: emerging trends and developments. Which of the following emerging trends in the reinsurance market is most likely to significantly affect pricing models in the coming years? A. Increased demand for traditional reinsurance products in stable, low-risk markets. B. The expansion of climate change-related risks, particularly for property and casualty reinsurance. C. A reduction in the number of reinsurance intermediaries involved in transactions. D. Decreased reliance on data analytics for underwriting and pricing reinsurance. Answer: B. The expansion of climate change-related risks, particularly for property and casualty reinsurance. Explanation: the reinsurance industry is increasingly focused on modeling and pricing risks associated with climate change, such as extreme weather events, rising sea levels, and temperature fluctuations. These emerging risks directly affect the pricing models used by reinsurers, especially for property and casualty reinsurance. Option is incorrect as low-risk markets do not typically drive significant pricing model changes. Option C is unrelated to the fundamental factors affecting pricing models, which are more influenced by risk exposure than intermediary involvement. Option D is incorrect as the industry is moving toward greater reliance on data analytics rather than decreasing it. Question 11. Topic: underwriting and risk assessment when assessing the risk of a catastrophic event. Which of the following would be the most critical factor for a reinsurer to consider in relation to exposure analysis? A. The number of policies held by the cedent. B. The geographic concentration of policies and potential vulnerability to natural disasters. C. The historical loss ratio for the cedent's claims over the past 5 years. D. The cedent's financial strength and ability to pay claims. Answer: B. The geographic concentration of policies and potential vulnerability to natural disasters. Explanation: in catastrophic risk assessment, the geographic distribution of policies is crucial. A concentration of risks in areas prone to natural disasters such as earthquakes, floods, or tornadoes increases the exposure to large losses. Option is insufficient on its own because the number of policies doesn't necessarily reflect the geographical risk. Option C is less relevant for exposure analysis, which focuses more on the likelihood of catastrophe occurring. Option D is important for solvency but not directly related to exposure analysis for catastrophe risks. Question 12. Topic: reinsurance accounting and financial reporting. Which of the following is true regarding statutory accounting principles? SAP for reinsurers. A. SAP allows reinsurers to treat recoverables as assets on their balance sheet only if they are collected within 90 days. B. SAP requires reinsurers to report all reinsurance premiums as liabilities until collected. C. SAP treats reinsurance recoverables as assets but only to the extent that they are recoverable from an authorized reinsurer. D. SAP permits reinsurers to report reinsurance premiums as income upon agreement coverage, regardless of payment status. Answer C. SAP treats reinsurance recoverables as assets, but only to the extent that they are recoverable from an authorized reinsurer. Explanation: statutory accounting principles SAP dictate that reinsurers can recognize recoverables as assets only if they are recoverable from an authorized reinsurer. This reflects the fact that reinsurance transactions involve risk transfer and an authorized reinsurer is subject to regulatory oversight, ensuring a higher likelihood of recovery. Option is incorrect, as recoverables are not conditioned on a 90-day collection period. Option B is inaccurate, since reinsurance premiums are typically recorded as revenue once earned, not as liabilities. Option D is incorrect because SAP does not allow for revenue recognition until payment is due, not merely upon agreement. Question 13. Topic: Reinsurance market practices. Which of the following is most likely to influence the increasing use of reinsurance intermediaries in Tennessee's reinsurance market? A. The rising complexity of regulatory requirements across multiple jurisdictions. B. The need for reinsurers to directly negotiate individual facultative contracts. C. The decline in the number of reinsurers offering catastrophe coverage. D. A reduction in the amount of data available to insurers for risk analysis. Answer A. The rising complexity of regulatory requirements across multiple jurisdictions. Explanation: reinsurance intermediaries are often utilized to navigate complex regulatory requirements, particularly when reinsurers and cedents operate across multiple jurisdictions. Intermediaries have the expertise to ensure that all regulations, such as licensing, taxation, and solvency standards, are met. Option B is incorrect because facultative contracts are typically negotiated on a case-by-case basis without the need for intermediaries. Option C does not directly affect the use of intermediaries, but rather impacts the availability of coverage. Option D is not relevant to the need for intermediaries, as data is usually abundant and the complexity arises more from regulatory challenges. Question 14. Topic: Legal and regulatory framework. Which of the following provisions is a typical feature of the NAIC model reinsurance law that reinsurers must adhere to in Tennessee? A. Reinsurers are exempt from state-specific tax requirements if they are domiciled outside the U.S. B. Reinsurers must establish a trust fund to secure their obligations to ceding insurers in Tennessee. C. Reinsurers must guarantee all future claims regardless of their financial status. D. Reinsurers are required to purchase a minimum level of facultative reinsurance to conduct business in Tennessee. Answer B. Reinsurers must establish a trust fund to secure their obligations to ceding insurers in Tennessee. Explanation: under the NAIC model reinsurance law, reinsurers are often required to establish a trust fund to secure their obligations to ceding insurers, especially for non-admitted reinsurers. This ensures that the reinsurer's liabilities are covered in the event of insolvency. Option is incorrect because foreign reinsurers may be subject to taxation depending on their specific agreements with Tennessee. Option C is incorrect since reinsurers are not required to guarantee all claims. Option D is irrelevant to the NAIC model reinsurance law and pertains to specific coverage requirements. Question 15. Topic: Claims and settlements when handling reinsurance claims under the follow the fortunes doctrine. Which of the following actions is expected from the reinsurer? A. The reinsurer may choose not to follow the primary insurer's decision if it believes the claim was handled improperly. B. The reinsurer must accept the claim as long as the primary insurer acted in good faith, even if the reinsurer disagrees with the underlying assessment. C. The reinsurer can deny coverage based on the original insurer's failure to comply with treaty terms. D. The reinsurer is only responsible for claims that meet agreed upon loss ratio regardless of the primary insurer's decision. Answer B. The reinsurer must accept the claim as long as the primary insurer acted in good faith, even if the reinsurer disagrees with the underlying assessment. Explanation: the follow the fortunes doctrine binds reinsurers to respect the primary insurer's claims decisions when made in good faith, regardless of whether the reinsurer agrees with the claim assessment. This principle ensures that reinsurers cannot second-guess the actions of the ceding insurer unless the evidence of bad faith or fraud. Option is incorrect because reinsurers are typically bound by the primary insurer's actions if done in good faith. Option C is incorrect as reinsurers cannot deny claims based on failure to comply with treaty terms unless specified. Option D is irrelevant to the doctrine as the doctrine focuses on the primary insurer's decisions rather than specific loss ratios. Question 16. Topic: Critical thinking and problem solving in reinsurance. A reinsurance company in Tennessee recently discovered that it didn't fail to report certain high-risk exposures under a treaty agreement. According to the contract's duty of disclosure clause, what should the reinsurer do in this situation? A. The reinsurer should automatically void the entire reinsurance contract due to the cedent's failure to disclose. B. The reinsurer should renegotiate the treaty to account for the undisclosed exposures. C. The reinsurer should determine whether the failure to disclose was material and, if so, seek to adjust the premium or limit coverage. D. The reinsurer should accept the claim without adjustments as the cedent has already agreed to the terms. Answer: C. The reinsurer should determine whether the failure to disclose was material and, if so, seek to adjust the premium or limit coverage. Explanation: Under reinsurance contracts, material non-disclosure may impact the reinsurer's ability to accurately assess risk. The reinsurer must first determine if the exposure was material, and if so, the reinsurer can adjust the terms of the contract, including premiums or coverage limits. Option is not correct, as the contract may not necessarily be voided without a material breach. Option B could be considered, but renegotiation is only appropriate after assessing the materiality of the non-disclosure. Option D is incorrect because a failure to disclose material risk would not result in automatic acceptance of claims without adjustment. Question 17. Topic: Emerging trends and developments. The increased threat of cyber risks is influencing the reinsurance market in which of the following ways? A. It is leading to reduced demand for cyber insurance products as the risks are deemed uninsurable. B. It is encouraging reinsurers to develop new models for underwriting and pricing cyber risk coverage. C. It is resulting in the withdrawal of reinsurers from the cyber risk market due to unmanageable claims. D. It is reducing the number of claims filed for cyber incidents as companies become more proactive in managing risks. Answer: B. It is encouraging reinsurers to develop new models for underwriting and pricing cyber risk coverage. Explanation: The increasing threat of cyber risks has prompted reinsurers to innovate in underwriting and pricing models for cyber coverage. These models are necessary to address the evolving and complex nature of cyber risk. Option is incorrect because the demand for cyber insurance is increasing due to the growing risks, not reducing. Option C is unlikely as reinsurers are more focused on developing strategies to manage cyber risks rather than withdrawing from the market. Option D is incorrect because the incidence of cyber-related claims has been rising, not falling. Question 18. Topic: Reinsurance for cyber risks. Which of the following is a key challenge in underwriting reinsurance for cyber risks? Accurately predicting the frequency of cyber attacks due to the evolving nature of technology. B. Determining the exact cost of a cyber event before it occurs. C. Ensuring that reinsurance agreements are only written for insureds with a history of cyber-related claims. D. Setting retention levels based solely on past cyber event data from a specific insurer. Answer A. Accurately predicting the frequency of cyber attacks due to the evolving nature of technology. Explanation: The primary challenge in underwriting reinsurance for cyber risks is the rapid evolution of cyber threats and technology, which makes it difficult to predict future events. Cyber risks are constantly changing in scope, and insurers must adapt their models to reflect these changes. Option B is incorrect because it's not possible to determine the exact cost of a cyber event in advance given the unpredictable nature of such events. Option C is incorrect because reinsurance for cyber risks is typically broader, covering potential risks, not just those with prior claims. Option D is inaccurate, as retention levels for cyber risks should consider broader industry data and trends, not just data from a single insurer. Question 19. Topic: Solvency and capital requirements. Which of the following would be an appropriate action for a reinsurance company to take if it is experiencing a decline in its solvency margin due to higher than expected claims? A. Increase its capital by issuing additional shares or debt to maintain required solvency. B. Reduce the scope of reinsurance coverage offered to limit potential future claims. C. Enter into more reinsurance contracts to offset the higher claims. D. Request regulatory approval to lower its solvency margin temporarily. Answer A. Increase its capital by issuing additional shares or debt to maintain required solvency. Explanation. If the reinsurer's solvency margin declines due to higher than expected claims, the appropriate action would be to strengthen the balance sheet by increasing capital through the issuance of shares or debt. This ensures that the reinsurer can meet regulatory requirements and maintain its financial strength. Option B is not optimal, as reducing coverage may limit future risk management opportunities. Option C is incorrect, as entering more contracts may increase exposure, potentially worsening the situation. Option D is not generally acceptable, as solvency margin requirements are typically non-negotiable, and lowering the margin would be inappropriate. Question 20. Topic: Emerging risks and adaptation. With the growing frequency of climate-related catastrophes, how should reinsurers adjust their pricing models for natural catastrophe coverages? A. Reinsurers should uniformly increase premiums for all policies, regardless of the geographical location. B. Reinsurers should incorporate more dynamic pricing models based on advanced climate risk models and geographic factors. C. Reinsurers should reduce premiums for high-risk areas to remain competitive in the market. D. Reinsurers should eliminate catastrophe coverage in high-risk areas to avoid underwriting losses. Answer B. Reinsurers should incorporate more dynamic pricing models based on advanced climate risk models and geographic factors. Explanation. Reinsurers should adapt to the increased risks from climate-related events by using more sophisticated pricing models that account for evolving risks such as climate change. This can include geographic-specific pricing, advanced climate models, and loss prediction tools. Option is too broad and doesn't address the nuanced risk in different regions. Option C would expose the reinsurer to significant potential losses. Option D is counterproductive, as reinsurers should adapt to new risks rather than withdraw from providing necessary coverage. Question 21. Topic: Tennessee Reinsurance Regulations. Under Tennessee Reinsurance Regulations, which of the following is required for a ceding insurer to claim credit for reinsurance from an unauthorized reinsurer? A. The reinsurer must provide collateral equal to at least 100% of its reinsurance obligations. B. The reinsurer must be rated A or higher by a recognized credit rating agency. C. The reinsurer must be licensed in at least one U.S. state. D. The ceding insurer must receive explicit permission from the Tennessee Department of Commerce and Insurance. Answer A. The reinsurer must provide collateral equal to at least 100% of its reinsurance obligations. Explanation. Under Tennessee regulations, for a ceding insurer to claim credit for reinsurance from an unauthorized reinsurer, the reinsurer must provide sufficient collateral, typically equal to 100% of its obligations, to secure the reinsurance recoverables. This ensures that the ceding insurer's policy remain protected. Option B is incorrect because a rating alone does not substitute for collateral. Option C is incorrect, as licensing in another state does not fulfill Tennessee's specific requirements. Option D is not applicable, as explicit permission is not typically part of the credit for reinsurance requirements. Question 22. Topic: Follow the fortunes doctrine. How does the follow the fortunes doctrine typically affect the claims settlement process in reinsurance contracts? A. It obligates the reinsurer to accept all claims decisions made by the ceding insurer without exception. B. It requires the reinsurer to indemnify the ceding insurer for claims as long as they are reasonable and within the terms of the underlying policy. C. It allows the reinsurer to independently review and deny any claims submitted by the ceding insurer. D. It restricts the reinsurer's liability to only the exact terms outlined in reinsurance contract. Answer B. It requires the reinsurer to indemnify the ceding insurer for claims as long as they are reasonable and within the terms of the underlying policy. Explanation. The follow the fortunes doctrine ensures that the reinsurer supports the ceding insurer's claims decisions provided they are made in good faith, are reasonable, and fall within the scope of the underlying insurance policy. This principle minimizes disputes and maintains smooth reinsurance operations. Option overstates the obligation by ignoring the need for reasonableness and policy terms. Option C misrepresents the doctrine, as it limits the reinsurer's ability to deny claims arbitrarily. Option D is incorrect because the doctrine extends liability based on the underlying policy, not just the reinsurance contract. Question 23. Scenario: Claims handling standards. Susan Insurance Company has ceded a portion of its property insurance portfolio to Delta Re under a proportional reinsurance treaty. A significant fire loss occurs and Susan Insurance settles the claim with the policyholder promptly. However, Delta Re disputes the claim payment, stating that Susan Insurance did not consult them before settlement. What is Delta Re's most appropriate obligation under standard claims handling practices? A. Delta Re must honor the settlement decision if it falls within the terms of the treaty. B. Delta Re can refuse to pay because it was not consulted prior to the settlement. C. Delta Re must only pay if the settlement was less than the original policy limits. D. Delta Re can initiate arbitration to review the claim before paying. Answer A. Delta Re must honor the settlement decision if it falls within the terms of the treaty. Explanation. Under standard claims handling practices in the Follow the Fortunes doctrine, Delta Re is obligated to honor settlements made by Susan Insurance if they are reasonable, made in good faith, and fall within the terms of the reinsurance treaty. Option B is incorrect because consultation is not always mandatory under reinsurance treaties. Option C is irrelevant as the focus is on the terms of the treaty, not the policy limits. Option D is incorrect because arbitration is typically a last resort for disputes, not a prerequisite for honoring valid settlements. Question 24. Topic: Non-proportional reinsurance. Which of the following best describes how a stop-loss from a reinsurance arrangement operates? A. It provides coverage for individual claims that exceed a specified limit. B. It limits the ceding insurer's aggregate losses over a specified period to a certain threshold. C. It reimburses the ceding insurer for losses above the primary policy limits. D. It shares all claims proportionally between the ceding insurer and the reinsurer. Answer B. It limits the ceding insurer's aggregate losses over a specified period to a certain threshold. Explanation. A stop-loss reinsurance arrangement protects the ceding insurer by capping its aggregate losses during a specified period. Once the losses exceed the agreed threshold, the reinsurer covers the excess amount. Option describes excessive loss reinsurance for individual claims. Option C applies to excessive policy limit coverage. Option D is incorrect as proportional reinsurance involves sharing all claims, not limiting aggregate losses. Question 25. Topic: Reinsurance accounting principles. Under statutory accounting principles (SAP), how are reinsurance recoverables typically treated on the ceding insurer's balance sheet? A. As liability to be settled with the reinsurer. B. As an asset representing amounts owed by the reinsurer. C. As income recognized upon receipt of payment from the reinsurer. D. As an expense offset against premium revenue. Answer B. As an asset representing amounts owed by the reinsurer. Explanation. Reinsurance recoverables are treated as assets on the ceding insurer's balance sheet because they represent amounts owed by the reinsurer for claims paid or reserved by the ceding insurer. Option is incorrect as recoverables are not liabilities. Option C misstates the treatment. The recoverables are recognized when due, not upon receipt. Option D confuses recoverables with premium accounting. Question 26. Topic: Retention levels and limits. Why is it critical for a ceding insurer to carefully determine its retention level in a reinsurance contract? A. Retention levels directly affect the reinsurer's underwriting profitability. B. Higher retention levels reduce the administrative costs of the reinsurance agreement. C. Retention levels determine the balance between risk retained by the insurer and the cost of reinsurance. D. Low retention levels are always beneficial for ceding insurers to minimize their liabilities. Answer C. Retention levels determine the balance between risk retained by the insurer and the cost of reinsurance. Explanation. Retention levels represent the portion of risk that the ceding insurer retains before the reinsurer becomes liable. Setting an appropriate retention level ensures a balance between risk exposure and reinsurance costs while maintaining the insurer's solvency and profitability. Option is incorrect because retention levels primarily impact the ceding insurer's financial position. Option B is not accurate as administrative costs are not directly tied to retention levels. Option D is overly simplistic and ignores the potential financial strain of excessively low retention levels. Question 27. Scenario: Claims handling and arbitration. Bryan Insurance Company cedes a portion of its commercial property portfolio to Apex Re under a treaty reinsurance agreement. After a disputed claim involving a catastrophic flood, Apex Re declines to indemnify Bryan Insurance, citing improper documentation of the claim by Bryan Insurance. What is the best approach to resolve the dispute under standard reinsurance practices? A. Bryan Insurance should resubmit the claim with additional documentation to Apex Re. B. Both parties should engage in arbitration if the treaty includes an arbitration clause. C. Apex Re is entitled to deny payment because of documentation deficiencies. D. Bryan Insurance should directly escalate the dispute to the Tennessee Department of Commerce and Insurance. Answer: B. Both parties should engage in arbitration if the treaty includes an arbitration clause. Explanation: Reinsurance treaties often include arbitration clauses to resolve disputes between the ceding insurer and the reinsurer. Arbitration provides a neutral platform to review and resolve issues such as claim documentation. Option is a reasonable first step but does not resolve disputes. Option C is incorrect because documentation issues alone may not justify denial if the claim is otherwise valid. Option D is unnecessary unless regulatory intervention is explicitly required, which is rare in reinsurance disputes. Question 28. Topic: NAIC Model Reinsurance Law. Which of the following is a key principle of the NAIC Model Reinsurance Law adopted in Tennessee? A. It mandates that all reinsurers must be domiciled within the United States. B. It establishes solvency and licensing standards for accredited reinsurers. C. It prohibits the use of facultative reinsurance agreements for primary insurance policies. D. It restricts ceding insurers from entering into treaties with foreign reinsurers. Answer: B. It establishes solvency and licensing standards for accredited reinsurers. Explanation: the NAIC Model Reinsurance Law provides guidelines for solvency and licensing to ensure that accredited reinsurers are financially stable and capable of meeting their obligations. Option is incorrect because foreign reinsurers can participate under specific conditions. Option C is a misstatement as facultative reinsurance is not prohibited. Option D is incorrect as treaties with foreign reinsurers are allowed if they meet regulatory requirements. Question 29. Topic: Catastrophic risk management. What is the primary advantage of using catastrophe models in reinsurance underwriting? A. They eliminate the need for traditional actuarial pricing methods. B. They allow for precise prediction of future catastrophic events. C. They provide a quantitative assessment of potential losses from rare events. D. They automatically determine the optimal retention levels for cedents. Answer: C. They provide a quantitative assessment of potential losses from rare events. Explanation: catastrophe models use historical data, simulations, and probabilistic methods to assess potential losses from events such as hurricanes, floods, or earthquakes. This helps reinsurers and cedents manage exposure and set appropriate pricing. Option is incorrect because traditional actuarial methods are still essential. Option B overstates the predictive capabilities of catastrophe models. Option D is inaccurate, as determining retention levels requires additional strategic input. Question 30. Topic: Ethical considerations in reinsurance in the context of reinsurance transactions. Which of the following best describes the fiduciary responsibilities of a reinsurance intermediary? A. The intermediary must prioritize the financial interests of the reinsurer over the ceding insurer. B. The intermediary must act impartially and in good faith while facilitating agreements. C. The intermediary must ensure that the ceding insurer receives the lowest possible premium rate. D. The intermediary must disclose only material information that benefits the reinsurer. Answer: B. The intermediary must act impartially and in good faith while facilitating agreements. Explanation: reinsurance intermediaries have fiduciary responsibilities to both cedents and reinsurers. They must act in good faith, ensure transparency, and facilitate agreements that are fair and meet the contractual obligations of all parties. Option is incorrect as prioritizing one party violates fiduciary duties. Option C misrepresents the intermediary's role, which is not to negotiate the lowest premium but to ensure fair terms. Option D is incorrect because full disclosure of all material information to both parties is fiduciary requirement.